Bank of America saying gold's a bubble, silver's a bubble, is absolutely propaganda framing. It's an Overton window that fails to recognize that we are in a scaled fiat and debt debasement period that will run and run and run until you've had the equivalence of bank failures, you've had debt markdowns, haircuts, all forms of embarrassing events that America never thought would befall them, probably some martial law, some social unrest. And in terms of inflation for Americans, the idea is actually to make imports too expensive. This is part of rebalancing these record deficits. You must buy less foreign stuff, because your cost of living is going to go up, you're not going to be able to afford it. And this is how they'll rebalance away from being the once hegemon with the Triffin's Dilemma and the exorbitant privilege of exporting paper to somebody who no longer can export paper, fiat, treasuries to the same degree.
Gold does not move because it reaches a particular number. It moves because trust erodes or stabilizes. A sharp overshoot towards $6,000 would likely require a catalyst that directly challenges currency credibility, such as disorderly bond markets, a breakdown in trade relations, or a renewed financial shock. These events are plausible, but they are not constant. For 18 years, the dollar index held a definitive uptrend. That trend just ended. With the monthly chart breaking below the 100 level, there is going to be a structural breakdown. The market sniper and precious metals expert FrancisHunt argues this is the endgame of Triffin's Dilemma. For decades, the U.S. exported debt to buy goods, but global appetite for treasuries is finally hitting a wall. Today we're looking at why the dollar's slide to the mid-80s might be the only path left. From a technical viewpoint, Hunt strongly rejects claims that gold is in a bubble, stating that rising gold prices reflect fiat currency debasement rather than speculative excess. In his view, the world is entering a prolonged period of debt markdowns, financial stress, and currency adjustment. As deficits rebalance and imports become more expensive, he predicts inflationary pressure will persist, a backdrop in which gold and silver continue to reassert themselves as true monetary anchors. Historically, gold and U.S. federal debt exhibit a strong 93% correlation, as the U.S. national debt surpassed $38.6 trillion in February 2026, growing at a rate of approximately $1 trillion every 100 days. Investors have increasingly turned to gold as a hedge against potential currency debasement and fiscal instability. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from FrancisHunt's recent interview.
Certainly people are taking delivery, and this discussion doesn't have the fullness that it needs without us first discussing the dollar, because we're talking about gold in USD. So there's two halves. One is the XAU, the other is the USD, and we should be a full half guy. We should see both sides, and this is where the dollar is currently. And we made a YouTube on this a couple of last week, I think it was. I don't want to say exactly. I'm not sure I'll be accurate, but if I just release this, these annotations that I've done, this is a very important chart that we've drawn. We've highlighted the $100 level in the blue line here. Since 2008 lows, this has been in a climbing channel. So we have actually called the dollar long. We're not just haters on America. Some people sometimes think we're not. We love the American people. We've always got on very well with them. They're great people. Sadly, what's gone on as a hegemon and the people that have been looking after their money haven't always been the best kind of people. But, we called this long on that target that came out of this upside HVF, for example, some time ago before. But more recently, the news has been bearish. And you can see the support the 100 was. It kind of kept these lows at bay. It kept those lows at bay. It kept those lows at bay. Then you broke the 100. And I'm going to zoom in this more recent history. This was just to show people that you've actually had an 18-year trend that is in a state of breaking down. A state of breaking down. Let's get rid of that Fibonacci there for a second. And you've now broken below the 100. And we've been entrapped in this sort of squeeze box of this ascending basing ascending grind line and the 100 level, and we've been rejected after running 100 both times, and now we've broken that to the downside. We're on the monthly time frame, by the way, just to remind everybody. We're on a monthly time frame. And here's my concern for the dollar generally. You've got to remember record deficits against Euroland and China. These are real problems. And nobody, the Triffin's Dilemma, a quick explanation fundamentally while we're getting the chart ready. When you're the hegemon, this applied for Britain prior. So as I say, please don't see me as beating up on America or Americans. When you were the hegemon, you export debt and your currency in lieu of excess received goods. So you typically get more imports than you have exports. Those other countries are not buying enough American items, China, Europe, but they are selling a lot more BMWs, Mercedes-Benz, or Chinese goods into Walmart, etc., than you are buying of their stuff. That deficit is being recycled into paper, and the paper is debt instruments and in your currency denominations. So your job is to proliferate your currency. We have now got to that point where we've reached peak proliferation, which is why our debt call in 2020, the debt markets have turned, and this is the most important call we've ever made, is such an important call, because the acceptance by other nations of that paper is greatly reduced and reducing further. This means treasuries are no longer sought as pristine collateral, dollars are no longer wanted to be had, and this is why we see the movement in gold, a monetary metal, a commodity that is actually a monetary metal and is money, all else is derivative proxy. We got so used to dealing in derivative proxy that we think the derivative proxy is the money. Gold is the money. Silver is the money. The derivative proxies are in trouble. So we're drawing a bear flag here for this, and we're saying you've come off a massive selling off down leg, and you formed this flag. You had a little rebound to the midpoint. You broke down. You had a gap down. You had a return move, and now you're rolling over. So we could see this going down. There is a possible target suggested. That doesn't mean it's always fulfilled. There's no 100% in pattern trading at around 87.738. That means more dollar debasement relative to another group of lepers that aren't much better. So you're not winning when you're losing ground to an already bunch of stupid. And that's the euro, 52% in here. There's a little bit of franc, there's a little bit of pound, there's a little bit of yen in there as well. The dollar's winning broadly against the yen, but it's become a lot more choppy. So these other currencies like the franc, it's losing quite a bit of ground. And the euro, it has to be said, which is not to say they are sound money. It just means in the relative world, given how big your overdraft got to be as a hegemon, you have been able to proliferate far more, and as a result are facing a far larger debasement. So I always push back against the trope, the dollar is the cleanest dirty shirt in the laundry. It is the largest and dirtiest, and it's by design. That's not a beat up again on my American friends. It's Triffin's Dilemma. And when people say, but Japan, add the unfunded liabilities of both nations in. Japan goes from 253% to 350% debt to GDP and buys its own debt. America goes from 135 odd to 600%. So you're going to renege on those commitments, or you're going to debase. Either ways are, both are reneging. It's just the manner in which you do it. So I'm on the weak dollar. Even if you did renege on Medicare, reduced how much you paid, all the people who've been paying all their lives suddenly get told they're going to get less, and those old people vote. Let me just remind everybody, you're going to end up with needing dollar debasement as well. So here's where we're at. This is part of the story. Gold wins here. Bank of America saying gold's a bubble, silver's a bubble, is absolutely propaganda framing. It's an Overton window that fails to recognize that we are in a scaled fiat and debt debasement period that will run and run and run until you've had the equivalence of bank failures, you've had debt markdowns, haircuts, all forms of embarrassing events that America never thought would befall them, probably some martial law, some social unrest. And in terms of inflation for Americans, the idea is actually to make imports too expensive. This is part of rebalancing these record deficits. You must buy less foreign stuff because your cost of living is going to go up. You're not going to be able to afford it. And this is how they'll rebalance away from being the once hegemon with the Triffin's dilemma and the exorbitant privilege of exporting paper to somebody who no longer can export paper, fiat, treasuries to the same degree.
During the interview, FrancisHunt states that the US dollar has likely peaked against the South African rand, highlighting its decline from near 20 to the low 16ths as evidence that even dominant currencies can reverse after extended strength. He argues that measuring assets in fiat terms is misleading, asserting that when priced in gold, assets such as copper are actually declining in real value. Ultimately, gold is positioned to outperform over the longer term amid ongoing currency debasement. On mining stocks, Hunt says margins are expanding significantly because metal prices are rising. Gold miners are positioned for a strong 2026, driven by high gold prices, expanding profit margins, and increased free cash flow from improved operational efficiency and disciplined capital spending. While discussing the gold-silver ratio, Hunt predicts that recent volatility may signal silver is preparing to outperform. That sharp spike in the ratio isn't a breakdown, it's a setup for silver to finally outrun gold. For the stackers watching, Hunt's stance is firm. The cycle hasn't peaked. Let's jump into the interview.
I'm sitting in South Africa in Cape Town. The dollar topped out in the rand at 20. And we said, that's it. This is peak dollar against a failing government here. In actual fact, the rand is now outperforming the dollar. The rand is now, and it's sitting at the low 16s by description. So that is, and this was a long trade. Everybody wanted dollars in South Africa. There was foreign exchange controls and all sorts of things. People dumped rands for dollars. It was a sure thing. It was a multi-decade thing. Now it's turned, and I'll maybe share that chart with you because it'll just show you, how in some senses the mighty are falling. This is a massive falling wedge. What are we looking at? We're looking at the copper continuous future that was on a monthly divided by gold. So yes, copper is up. You saw the chart, all-time high in dollar. But what does that mean in the new original, the old money standard of gold? Which is now the new one again. We've gone the full circle and we've gone, you know what? Gold ounces are the way to measure your wealth. Well, in that sense, we are seeing a debasement of all assets to gold, with the possible exceptions of miners, silver, platinum, and very, very few things. And here you have a consistent grinding out of copper. So are you better served being long copper than gold? Right here, right now, I'm saying no. Your new benchmark is the harshest benchmark, and you are in debasement times. You're just using the wrong basis of account, and they are playing monkey money games with you, showing you this depreciating fiat and saying your house is still worth the same. You're doing great, or you must pay us capital gains tax for making money on your house because you made more than what you bought it for. But that unit of account from 2-3 years ago is not even the same unit of account. In gold ounces, your property is rebasing downwards. Everything is rebasing downwards. And here's a chart you really liked. It's rebasing downwards. We actually have an upside break on oil that we expect for the first time. We've been relatively quite bearish. Oil, we've highlighted that it's going to underperform generally the monetary metals. But let me just show you an interesting fact. We've got a technical setup for it. Your guys can have a trade if they like on it, if they like the setup. There it is right there. This is on the hourly, and I would use our HVF method, which is a unique bespoke methodology that we use to trade. And I would say, there you go. You've got a trade coming for you in oil. We can see 69, that probably means a technical run back above 70. But then go and that's a bullish trade for now, but go and see how oil has generally done against our friend gold, our harsh, stern master of fiscal discipline, and you will see that it's a totally different story. I'll put it out on the monthly, and you can see it that in actual fact the oil has been rebasing downwards. In fact, we've got a head and shoulder draw. I just want to miss the COVID spike, it distorts the chart. We have pulled this downwards for an extended period. Head and shoulder over here, boom, boom, bosh, broke over there. Targets being run, see that target rally, down, 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 a hammer now. You're going to get a little bit of an up move against the dollar for oil, but you may find that you're getting a better move in gold to the upside. And that's where everyone should position. So once again, in a debt and fiat-based collapse, which Bank of America is not telling you about because it affects the banking system too, have the monetary metals. Precious metals, gold and silver, will be the outperformers of this cycle. You asked about the gold-silver ratio, and it's a great question, Daryl, so I want to take you back straight into the weeds of that and say, you remember what I was showing you in the gold chart with the shooting star that had the intra-week reversal. It had a body like that was red, and it had that huge wick that did that. And how I said the only way you negate the bearishness of that is you have a squaring up and an equally strong reversal to the downside like this. Well, look what's happening here on the gold-silver ratio. We were talking about the gold had that shooting star, and that's actually a very bearish candle, especially on a weekly time frame. That's quite a long one. You had that shooting star. And then I said, one of the only real ways that you can put it back into bed and go back into the reflation and upside is if you have a hammer to the downside of equal scale, then you continue back up. In other words, you had a blow off, you had a collapse, you had an overshoot to the downside. Now you're bouncing back, you negate that. Well, you've had very similar here. You've got a very strong hammer, which is actually bearish for precious metals. The gold-silver ratio going up, it's actually generally bearish. It doesn't have to be hugely bearish. Gold can sometimes go up in that environment, and silver can be flat or mildly down. But what we're now getting in terms of this month is you've had a reversal on the follow through here, and it looks like this green candle is coming back down. This green body may end for the month, and bear in mind we're only the 10th. So again, I'm calling early, but you're probably going to have a reversal, having run up to back into the 70s. And we expected this because you ran the key level of 50 on the gold-silver ratio. You ran it to the downsides, you got a snapback rally, you ran all the way back into the 70s, and now you're coming slowly with your way back down. So this is just a period of volatility, a little bit blow-offy. I'll move it on to the weekly time frame, because when I showed you those shooting stars, it was actually on weekly. So you had quite a big surge up, but then you see this wick has come a long way down, and actually you're trading red here. So I think the reflation of precious metals post a little bit of a slap in the face for doing too much too soon is very much back on the cards. So dip buying is part and parcel of this. Please bear in mind, this is not the same as my leverage trading that I'm sometimes talking about on YouTube, and that we update our community on, which has been very profitable. So as an investor and a stacker, we say keep stacking. There's no way you're anywhere near the highs at this juncture.
While gold continues to hit record highs as a safe haven asset, silver has shown even greater volatility and potential, with some analysts anticipating a move toward triple-digit prices due to severe supply deficits and explosive industrial demand. If trust in fiat currencies continues to erode and structural debt pressures intensify, are we witnessing the early stages of a full monetary reset? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.